All right, what's up, guys? I hope you're doing well. James here from jamesdforsythe.com. As you can tell, if probably maybe the sound different and also a bit different background. I'm in a hotel room this time. Just actually brought my webcam. Didn't forget it this time, so I don't have to do all of them just from my phone. But anyways, I've been traveling a lot for work the past couple months, so yeah, there's that story. But anyways, get right into it. So talking about the actual like foundational principles for a CBDC and the actual issuance from a central bank's perspective, right? And so we'll head straight over to the screen share to the PDF. Um, as the past three videos or so, um, this is from one of the reports from multiple central banks and the BIS, I believe. Make it bigger for you guys. All right. And so pretty much just kind of what you would assume, at least in terms of the three foundational principles that if you can see that right there. So basically they want to do no harm, coexistence, and innovation and efficiency, right? And what they mean by do not harm is basically not harm themselves. So basically, implementing or issuing a central bank digital currency should not interfere with or impede a central bank's ability to carry out its mandate for monetary and financial stability. And then coexistence, that one's kind of self explanatory. Basically, it should coexist with various forms of money already in the system, right? So whether that be existing cash, other central bank liabilities like reserves, bank reserves, or settlement accounts, and then also, as they say, robust private money, which is your commercial bank accounts, right? And then innovation and efficiency. So without continued innovation and competition to drive efficiency in a jurisdiction's payment system, users may adopt other less safe instruments or currencies. Ultimately, this could lead to economic and consumer harm, potentially damaging monetary and financial stability. Right? As stuff you'd assume are that shouldn't come as a surprise from hearing from the central bank. But really, the bulk of this video and what really the meat is supposed to be is these core CBDC features they give. And so, as you can see, they actually break it up into the instrument, the system, and institutions, right? And we went a little bit into why it's broken up and the differences between a CBDC is kind of that you have the instrument, which is like the currency itself, and then you have the system in which you actually like distribute the instrument, so to speak. And so each will have different characteristics, and there's also different trade-offs and everything, right? And so one of the instrument features is convertibility. They say to maintain singleness of the currency, a CBDC should exchange at par with cash and private money. Basically, if it was a stable coin, it'd be stable. There'd be 1-to-1 all the time and be fine. It's like money market funds, how you're not supposed to break the buck and go below par, right? And it should be convenient. It should be as easy as using cash. Um, it's also basic. It's supposed to be a digital central bank liability, right? And so a cash is a physical central bank liability. So it's supposed to be like this as convenient as cash, to use their term exactly. But that's kind of the purpose, right? It needs to be accepted and available. That's obvious as a currency. People have to accept it as a currency, have faith in it, and then they have to have it available to even use it, right? And this mostly the availability comes up with the ability to make offline transactions, which is something that they kind of think about, right? Especially from a kind of a digital currency perspective, because you can pay with cash offline. You can just hand it to someone. But with digital currencies, you'd have to figure out a different way to do that, right? It also has to be low cost, at least for end users, right? Now you can argue like if this is some form of Fed coin, it doesn't necessarily have to have no cost. That's a different topic. Um, but in low cost or no cost for end users, the people actually using it. Um, 1 second, I'm gonna double check to make sure that everything's still good. Looks like it. Gotta double check on this hotel Wi-Fi because who knows how bad it could be. This one seems to be going good so far. But in terms of the actual system itself, back on CBDCs, so the system in which they actually distribute this, or however, whatever kind of financial infrastructure they actually build for this, or proposedly build, to keep in mind this isn't a sure thing. Um, this is more of a discussion paper to kind of discuss trade-offs and such. So take that for what you will. Everyone has their own opinion on that. So, anyways, this system, a core feature of the system that they would have to have is secure. Obviously, if you're going to have a digital form of money, it has to be resistant to cyber attacks, just like the commercial banking system is. That's one thing that's one negative consequence that would come from this, that they do bring up later, is having a what general purpose central bank digital currency. There would be many, many more endpoints, is what they call them. So basically, ways for a cyber attack to occur than in a closed loop kind of system similar to what we have now, somewhat. Okay. Also, the actual settlement should be instant or almost instant to where the end users don't notice it, at least. Um, kind of like paying with your debit card in a way. At least you don't notice it. Sometimes they put card holds on there depending on what you're doing, like if you're buying gas. Other times if you're going to the store, normally you don't even notice. So there's that. Okay, it also the system itself has to be resilient. I mean, that's any financial system. At least that's a feature you would hope it would have. It should be extremely resilient to operational failure, and other disruptions. Obviously, availability. You have to be able to transfer this 24/7 every single day, every year, or all year long, all the time, right? Just like you could physical cash. It's in your hands, you can hand it to somebody. You should be able to use whatever this proposed digital currency is in the same fashion, right? At least that's the hope. However, since it is digital, you do have to think about throughput. And so basically, the system itself has to be able to withstand such a high number of transactions, or a very high number of transactions, and do that efficiently, right? It also has to be scalable. So to accommodate potential for large future volumes. So maybe an influx of many, many, many more people actually using it. Or say some event happens in a market and there just happens to be, whatever the reason may be, um, orders of magnitude more volume on that day for whatever reason, right? It has to be able to withstand that. Kind of the same idea as throughput, right? And then there's interoperability. We've talked about this quite a few times with the problem with cross-border payments and using it between, or using central bank digital currencies between nations with different currencies, and they would each have to have their own, which is something they do bring up in this report and future ones as well, is that each each country has, or each central bank would tailor their CBDC to whatever their specific needs are, right? And so each CBDC would be different to some degree, probably varying degrees. And so they have to be able to communicate with one another. And so you basically like a foreign exchange for these. Now, rather that if that's set up just like the Forex is now, who knows, right? Okay. It also has to be flexible and adaptable, as with every currency. In terms of institutions itself, kind of weeding out where um, who has legal authority to deal with it, and all that kind of stuff you have to deal with. Like, does the Fed have control? Does the Treasury have control? Does some other part of the executive branch, whatever agency, have control? What is it? To what degree do they have control? What authority do they have? Um, and so, obviously, coming from the world central banks, their idea of, as they say, robust legal framework is a central bank should have clear authority underpinning its issuance of a CBDC, because this is a central bank digital currency, and so obviously it's going to be a liability of the central bank, and so any kind of meddling or kind of fusion between the monetary side, the monetary system with the central bank, and the fiscal side with the government is kind of, we'll go with kind of in flux, I guess. I haven't seen they haven't talked too much about this stuff so far with what I've read in terms of their actual discussion papers and the other articles and stuff that they've written. So there's that. Also standards. What standards are they going to have from an institutional perspective? So, right, in terms of infrastructure. So, how would participating entities have to conform, or what kind of regulatory standards would they have to deal with? Right, much like the commercial banking system deals with now. Right. Um, so we're going to leave it there because we're getting into a new section. So this is all about the issuing of an actual CBDC and kind of the core features and stuff that you would need to know. And in case you want to, and I highly encourage you to read it yourself, this is just the first report, as it says, in a series of collaborations. Here's a list of the actual central banks that they use, or that are a part of this and have contributed: Bank of Canada, ECB, BOJ, so on, right? So, and as always, a link will always be in the description for any sources that I use. There's that. So, and anyways, I hope that's helpful, and I'm gonna leave it there for tonight. So I hope you guys have a good day, and I'll see you on the next one.